welcome back to another episode of Fun Friday with an incredibly special guest, an author about something that's very near and dear to Lone Star Capital. It's been a vehicle for us to make tons of money, a vehicle within real estate, known as the 1031 exchange. If you know anything about Lone Star Capital, you know anything about what we like to do, this is a very important episode that our special, distinguished author and guest, Dave Foster, is about to unpack today pertaining to the 1031 exchange structure. So please, Dave Foster, welcome to the show. We are so excited to talk to you today.
Holy cow. That's a lot of adjectives to live up to, Craig, but I'll do my
Yes,
best. It's good to be here.
awesome. Well, give us a little bit of the background because you've got a unique way 25 years ago before kind of getting into this world now. You said you had a really cool story, but before getting into real estate, how did you kind of get into this world and kind of accumulate your skill set?
Yeah, it's been said that we're all the sum total of our mistakes in life, right? And how we recover from those mistakes. Well, 25 years, or actually almost 30 years ago now, I made the biggest mistake of my real estate career. And it was my first real estate deal. Does that sound familiar to anybody?
Yeah.
Um, my wife and I were living in Denver, Colorado. And to set the stage, you've got to understand that I'm a Kansas farm boy. She's a Minneapolis city girl. We're living in Denver, Colorado. And somebody decides to go buy a boat and raise their family on the ocean. I have no idea where that came from. But regardless, we were looking for a way to maximize time with our family. And so becoming real estate investors seemed like a very natural fit. So because my other nickname, Craig, is Ready, Fire, Aim Dave, I went and I bought a duplex in Colorado. I fixed it up. I put a renter in it. I sold it. I said, man, I'm the king of the world. Till I talked to my accountant. And I am an accountant who has an accountant who laughed at me. But he said, you're going to write a check for $30,000 to the IRS for this. And I said, that just does not seem right. I didn't realize that I had a silent partner named Uncle Sam, and he was going to do about as well as I did on this thing.
Right.
So that put our 10-year goal in jeopardy to buy the boat and move aboard. I went, what else can we do? And it was right at that moment that a huge court case was settled between the IRS and some taxpayers. The IRS lost. And so now there was going to be a whole new way to do this thing called a 1031 exchange that was going to be usable for folks just like you and me. And when I saw that, some friends of mine said, Dave, you should have that. I said, yeah, no kidding. Thank you. They said, why don't we start a business? And so we formed a business doing this for others. And literally, after 10 years, almost to the day, of using the 1031 exchange in our real estate dealings and our primary residence exemptions, we were able to buy and move aboard a 53-foot sailboat with tax-free dollars and live on it, raising our family for 10 years, living off of our fleet of vacation rentals, all purchased in part with deferred tax dollars from the IRS. So I turned Uncle Sam from a taker to a giver and enjoyed the benefit of it. And that's what I've been doing for folks ever since because it's been so powerful for me.
You know what? You must have spent a lot of time on a boat and you must be familiar with a hook because that was certainly an impressive hook to get everyone locked into this right here. To go from paying $30,000, which I'm sure that was a bit of time ago. You said maybe 20, 30 years ago. So that was when $30,000 was actually $30,000. As we know, inflation has really hurt the process, which is very accretive to the 1031 structure. So we don't pay extra taxes, but very interesting there to lock us in. So let's talk about the 1031 exchange process, your business that you formed, and all the accretive tax loopholes that you can speak on pertaining to real estate. And also, when it comes to the exemption, I must say, I also am taking place and enjoying that exemption myself because I just sold my house, had a nice gain, and threw that gain into another real estate deal, which, of course, when that sells, coming up with Lone Star Capital will also be 1031 exchange as well. So take advantage of the accretive loopholes that the real estate has. But back to the question. So let's talk about your expertise with kind of the tax benefits you get through real estate and all the fun loopholes that we're going to talk today about, take advantage of to create and pass down wealth while being tax lean and efficient.
Yeah. So the two greatest tax benefits that the IRS gives us with real estate are, first of all, that primary residence exemption that you just mentioned. All you've got to do is buy a house, live in it for 2 years, sell it, and then you will get to take either the first $250,000 of profit tax free if you're single, 500,000 if you're married. Nothing to do other than buy a house and live in it. I mean, how could it get any better than that?
I
And
can't.
well, actually, it could, because you can do it once every 2 years. Now, this has been something that's a relatively last 15, 20-year change, but this whole statute's caused some really interesting unintended ripples throughout real estate, because you used to be able to do it only once in your lifetime. So think about that whole move up mentality that we've developed, where you've got to go bigger, 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 bigger. In part, that was because people were always having to save up so that the house they took their exemption on was the biggest house. Well, now in one fell swoop, you don't have to worry about that. You can stay in a size of house, a mortgage payment that's comfortable. You don't have to stretch yourself. Every couple of years, instead of redecorating, you move, and that money's tax free. It's If people get a handle on this, I know there's a lot of gurus out there that are saying you should not own your own house. That's the greatest tax benefit ever. And I
I
would
couldn't
encourage
agree
everybody.
more. Yeah.
Yeah. That's what actually bought the boat, was because we did that periodically. And every time we sold that money tax free, it went into the buy the boat kitty. So I bought a boat with tax free dollars. Now, the other half of the statute, other part of the statute, is Section 1031. And what Section 1031 allows you to do is to sell a piece of investment property, and by using the process, purchase a new piece of investment property, and you get to indefinitely defer paying the tax on that gain. So it's not quite as good. It's not tax free, but it's indefinitely deferred. And it's funny that you mentioned that $30,000 and how little that is compared to now. You want to hear how that gets even worse? And it does keep me up at night still. Take that $30,000 and amortize that at compounding interest at 10%, which is a pretty easily achievable real estate gain. If I would have made 10% a year on that $30,000 for 30 years, that's almost $1 million that I would have in my pocket from that first stupid transaction. And that's why I learned from it, because I said, never again are we going to go through that. So the 1031 allows you to start gaining the compounding effect. You're not just buying real estate and making money doing it, you're making money on the money you don't have to pay in tax. And that springboards everything. So
I
that's why the
That's
1031
so good.
exchange is so huge.
Well, and then so let's also just factor in one more item here, which I don't think not everyone in the real estate business, which obviously you're so entrenched in, I am as well, also think about this. But when you also do a refinance as well, and there's a gain there, you can also take dollars out through a tax-free refinance as well. So those are three gains and strategies that the real estate world has that you're not going to get elsewhere, right? So let's break this down one further. Let's say you buy Apple stock. Okay, you buy Apple stock for whatever, you've got a nice gain. Well, you can't 1031 exchange, sell that Apple stock into Google or Meta or Nvidia. You have to sell that, take that gain, the capital gains, and then put it into the next one, so on and so forth. As opposed to the strategies we're talking about here, which everyone can do. This is not rocket science. This is not any item that's not known. This is just using the tax code to your advantage.
Yeah. Interesting factoid, Craig. The impetus for this entire statute came from 1920. This is when it was put into code, but so many people still don't even know about it. But it was put into code that time of year or that time in our country, we were just coming out of World War I, and our country was incredibly hungry, but our agribusiness infrastructure was not where it needed to be. We couldn't feed ourselves. We couldn't move into the industrialized age. So what was happening was farmers who wanted to grow bigger could not sell their farms and buy a bigger farm because they couldn't afford to pay the tax. So Section 1031 let those farmers keep the tax and use it so they could buy bigger farms, which was great for them, right? Think about that as a real estate investor. I get to keep the tax, I get to buy more real estate than I would have. And what it also let people do was it let the people wanting to become farmers get in, because now there were small farms that they could start with. So what started out as a benefit for farmers is now out there for real estate investors. And I just cannot imagine a greater benefit.
I can't either. And this is my kind of reasoning and justification as to why real estate, in my opinion, is the best asset. I mean, obviously, they're not making more of it. The government can't just print more real estate, obviously, but you get the incentivized to do it. So if you can kind of couple all these items together, just really goes to show that real estate really does have one of the more compelling pieces of alpha as well. And then obviously the Trump administration, which is being currently sunsetted and may come back, and then you throw in another layer of things, which is that bonus depreciation that we're getting before. It's obviously sunsetting right now. I am a believer that one tax code changes and another one opens. So I do think that will come back there, as well as the commercial real estate market may go into a slight depression here coming up, with interest rates basically tripling in a very quick period of time. So I do think we're going to see 100% bonus depreciation coming, which will also help, just more. Basically what that does is help offset more taxes and whatnot, and gives you a very nice write-off year one to incentivize people to owning real estate. But it just goes to show that the government doesn't care necessarily if you own real estate, but it incentivizes you if you do own real estate. So that's just a mindset piece that I really want to instill into everyone who's listening to this, that they don't care if you own it, but they incentivize you for doing so.
Actually, a great way to look at the tax code in general. It's not how the government gets our money from us, although they're pretty good at doing that. It's the government's way of incentivizing behavior. And when you perform that behavior, like you said, they reward you for that. So, what behavior are they trying to reward? A vibrant real estate economy is essential for a healthy economy, because when you're investing in real estate, those are big assets that take dollars, both M1 and M2 dollars, off the street. So they're an inflation fighter. The government prints it, we buy real estate and tuck it away. And for every 1031 exchange that happens, there's two realtors that got commissions. There's two painters that got to paint the house, two appraisers that got to appraise it, two real estate attorneys, on and on and on and on. So they're actually encouraging a huge sector of this market to grow. And that's pretty huge, yeah.
Well, also, to go off that point there, Dave, as you know, being in the markets and investing longer than I have, as I'm, just a 29, 30-year-old, maybe when this will get released. So I have a little less historical data than you do, of course, but I think you can kind of speak to this, that stale dollars, meaning dollars that aren't moving around, is not what, creates a vibrant and healthy economy. It's when money is moving and circulating is when things are doing well. So when the real estate market's doing well, people are buying houses, selling houses. Well, let's say if you flip a house, right? The lender gets paid, the title people get paid, the seller gets to move on and do whatever they need to do with their dollars there. Now, what happens to that house? Okay, this house gets painted, as you said, new kitchen, new appliances, new this, new that. All these sales come through, and all these people get money traded into their accounts and into their hands via this process of the economy doing well and real estate trades occurring in real time. So the trickle down effect is really immense. And then to go into kind of the house analogy there, it's really sad that I do think that, it's certainly market dependent. If you're in San Francisco, if you're in New York, it's probably maybe not the most accretive structure to own homes. But let's take out some of obviously the uber gateway expensive markets. If you're just an everyday person and you want to build wealth, buying a home, I think, is very essential for that. I think there's a lot of negative rhetoric pertaining to that, like costs associated there. But just because maybe you didn't buy correctly, or maybe that you don't know what it is, you don't research it enough, doesn't mean there's not a fortune to be made in that space there with these, deductions, with, the multiple time exemption and whatnot. So I just really want to bring that point home, is that you really can make a lot of money in that single family space. Now, we obviously do commercial real estate here at Lone Star Capital. Do I think that has a little more alpha and upside? Yes, but that doesn't mean you should exclusively be there. You should look at all forms of real estate as options and items for you to make dollars in.
Now, interestingly enough, the 1031 exchange, any type of real estate can be used, and it's all considered to be like kind. So whether it's commercial, residential, now we're not talking about your primary residence, that's different, but any type of investment, raw land, commercial, industrial, what residential can be exchanged for any other type. And you mentioned location. It can be exchanged into any other location in the United States you want. So think about the power of this. Remember, the whole point is that you're doing the 1031 so you get to use the tax dollars for yourself instead of paying them to the government. But you can meet whatever the market is telling you by using the 1031 exchange. Are you in an area that's been maybe you bought a house and your spouse bought a house and then you get married, you've got an extra house. So what are you going to do? Let's rent it out. So you rent it out, you just became a landlord. And now a few years go by and that house was in Los Gatos. Well, it's going to be tough to make a lot of money rent wise. It's appreciated pretty darn well though, hasn't it? So why don't we do like a lot of people did in 2014, and let's go follow Elon to Austin? So we sell in Palo Alto or wherever we had it, and we use the 1031 exchange, tax deferred, to go purchase much cheaper places in Austin, Texas. So you go from areas of high appreciation and high cost to low cost, areas of very little cash flow to places where you can get more cash flow. You can go from single properties to multiple properties, from active to passive. Whatever it is that the market says is the right sector to invest in, you can use the 1031 exchange to get there. So it's got a lot of flexibility to it, as well as the compounding effect.
It's really funny that you mentioned the Silicon Valley there, because that's actually where I'm from as well. I'm from Menlo Park, California. Funny enough, I have friends that are from Los Gatos, friends from all over that area, and many friends and many people that I know also went from, funny enough, you should say, that kind of Southern California, or sorry, Southern Bay Area, peninsula area over to Texas, Austin even as well, specifically, so I can speak to that. But also another interesting thing is it allows you with the flexibility to trade in and out of markets that you deem, better than others, or maybe higher growth, right? So let's kind of break that down for a second. If you are in, per se, the Bay Area, which has kind of been plateaued on values of late over the last, maybe since COVID, policies have really changed. Well, guess what? You're not locked to be there forever. You can go to a high growth area like Texas. You can go to a high growth area like Phoenix, Arizona, like Florida, like Tennessee, somewhere in Nashville. You name it. You can go there and have that flexibility and autonomy. So it's really just the best structure. And I get so passionate about this because everything you're saying is so accurate there. And also, maybe you figure out that there's a better value place in industrial real estate right now as opposed to single family homes. Maybe you're in a place in life where, you're someone younger, maybe like myself, and you want to own a rental house that, maybe it doesn't have the best cash flow day one. Maybe it's basically breaking even. It might be a bit of an alligator property, but you know that you can kind of force some appreciation there, trade up in value. And then by the time you're looking at a retirement age, you put that into a structure, maybe like a triple net property, maybe like multifamily property or industrial that has a higher cash on cash return, maybe a little less growth to fit and suit your needs.
Boy, you are feeding right into what I talk about being the four pillar D's of 1031 investing. When you just talked about starting to aim towards retirement, the first D we talked about, which was the compounding effect, whether it's 2 years or 20 years, that money's making money for you when you defer the tax. We talked about the second D, which would be defer, because you can let the market speak to you. And wherever we're at, in a very predictable but not timeable real estate market. You can move the assets. What you're starting to speak about, Craig, is so even more important because the third D, I would say, is also defer because the 1031 exchange is going to allow you to meet and accommodate wherever you are in your own personal journey. I'm not the same investor I was 5 years ago. I'm not the same investor that I'll be in another 5 years. Our needs change, our abilities change, our appetites change. So, like we talked about going from one property, that first starter where I had to scrape everything together that I could to get. Well, then I sell that and I go buy two. And then I sell the two and I buy four. And I'm using the tax dollars to do that. Or maybe I'm later starting to think about slowing down. So I sell five properties to go buy one triple net commercial that could be passively managed, or triple net commercial where the tenant is paying the taxes, insurance, and maintenance. Or maybe I'm in that tweenerville where I'm a successful real estate investor who's now starting to think about building memories. My kids are young. Why don't I take some rental properties and go buy a vacation rental in the Smoky Mountains on the beach where I'm generating income? I'm getting depreciation. I'm getting all the prongs of the internal rate of return. But my family and I can also go and use it periodically and build memories. Whatever it is that your needs are, maybe it's time to look at retirement. And this, I just love this because this is, I think, the greatest hack because we're going to combine Section 121 and Section 1031 if you want. It's like adding where we're going to add gasoline to the fire.
Let's do it.
So a couple of years ahead of retiring, I'm a real estate investor in Cincinnati, and I know that I want to retire in Sarasota. So if you that, I start 1031ing my properties from Cincinnati to Sarasota. One of my 1031s is going to be a really, really, really nice beach house. Now it's time to retire. So I'm going to sell the home I live in. Now remember, that's $500,000 tax free. So I put that in my pocket. That's a nice little nest egg to start retirement with, isn't it? So I could go down to Sarasota and I could go buy another house. But because Section 1031 allows me, I could actually convert that really, really nice beachfront property into my primary residence. So that $500,000 tax free stays available for whatever I want, whether it's betting on the horses or the cruise to Alaska or whatever I want to do in retirement. But the conversion doesn't trigger the tax. So as long as I own that property, I'm now living in a property paid for with tax dollars, but I'm living in it tax free. And if I ever sell it after living in it the right amount of time, I will get to have converted a portion of that tax deferred gain into tax free. I've got a client that did this on St. Pete Beach. He bought three in a 1031 exchanges. He bought three identical condos. Beautiful place, all on the same floor of the same building. Now, he rented one out for a couple years, and then he sold his house, retired, moved into it. No tax due. And then he lived in it for 3 more years. Now, the IRS says that if you have owned it for 5 years, if you've lived in it for the 2 out of the previous 5, then you get to prorate the gain between the amount of time you lived in it and the amount of time it was a rental. So he'd owned it for 5, he lived in it for 3, so he took 60% of the gain tax free. He eliminated 60% of the tax. You know where he moved? Next door to the next one and
Incredible.
started the
And then
clock
kick the
ticking
can.
on that.
Yes.
Yeah, daisy chained it. We all are mobile, fairly mobile like that because we're going to start downsizing. Why not downsize into investment properties and start converting that gain from tax deferred to tax free?
Makes all the sense in the world. So let's talk about the fundamentals and the timeline and the process associated with the 1031 exchange process. So, this is all good information, but we can't apply it. It's, for, a nice thought. So let's say hypothetically, we've got some property that we're going to sell, and we have $1 million gain or so roughly, or it's $1 million of equity. It's on the market now. What are the steps? How does someone call you as an intermediary, as I believe you said you are? How does someone call you, implement these strategies to not pay a cent in taxes? Because if there's one thing I know, people that I know and that I talk to, they hate taxes. So break it down for us.
Yeah, the from a procedural point of view, it's really very transparent for the investor. You do nothing differently other than put your properties up to market and sell like you normally would, locate, identify, and buy properties like you normally would have. That part's exactly the same with all of the same professionals. But in between that sale and that purchase is the very, very, very rigid process called the 1031 exchange. And the devil, of course, is in the details right there. Because first and foremost, the IRS requires that you use an unrelated third party called the qualified intermediary. That's what I do. We process the 1031 exchanges for people, and we have to be involved prior to the closing of the sale. So that's when it all starts, is at the closing of the sale. There's documentation that's part of the 1031 exchange in the settlement documents, and you cannot touch the proceeds. So all of that equity that's left after the sale has to go into your exchange account. If you touch it, it's taxed. Remember, the IRS lost a lawsuit. So they're pretty grumpy still. They have to let us do it. They don't have to make it easy. And they want to make sure that at the end of the day, they don't trust us. Okay, I get it. I don't trust them either, but that's another deal for another day. So from the date of the closing of the sale, you only have 45 more days to identify your potential replacement properties. And you have a total of 180 days to close on it. So it's a fairly constrained process, but it's pretty manageable. People get hung up all the time on the 45-day period. And I say, really, how long does it take you to find a house usually? Oh, a month or a month and a half. That's 45 days. Um, and you can always, you should always be shopping prior to the closing of your sale. You can even go into contract for your new property prior to the closing of your sale. We just have to close the sale before you close the purchase. So those timing things don't have to, there's ways to work within them. The same taxpayer for the old property is going to be the same taxpayer for the new property. And if you want to defer all tax, you simply have to purchase at least as much as your net sale and use all the proceeds from the sale. So you might have been with $1 million in equity, you might have been selling that property for say 2.1 million, and there was $100,000 in closing costs. So your net sale is $2 million. There was $1 million loan on it, so your net proceeds are $1 million. If you want to defer all tax, use all $1 million to go buy at least $2 million in new real estate. That's 8,000 pages of case law summed up in 2 minutes. The key, the qualified intermediary who's your guide through the whole process. So, in some ways, yeah, it can be intimidating, but I like to tell people really the only scary 1031 is your first one. And I love it when when folks now, they shoot me an email or a text, or they just call my staff and say, yep, doing another exchange, go for it. Because they understand now and they can work within those. And it's a fairly easy process.
Yeah, well, it's interesting because the scariest part about it is the phantom income and all of the kicking the can to the line if you don't completely do it and conduct it correctly. Because there is certainly a recapture that is pretty significant should you not find the correct financing partner in that opportunity. And interestingly enough, our biggest investor with Lone Star Capital, Park Row Equity Partners, has given us a very handsome amount of equity, 8 figures worth plus around handsome eight figures worth of 1031 exchange dollars. And the interesting thing about that is if we could not successfully go through that process, they would owe a lot of dollars in taxes. They maybe lose all their equity gains theoretically just due to the whole nuances associated there. So it can be scary if it doesn't work correctly in that regard. But it needs to be managed correctly. It needs to be managed timely, but it is very doable. So it just goes to show that there are options out there. But it can be scary because the recapture could be so great. If you want to maybe talk about that, perhaps.
Yeah. So, well, it's not just the profit, isn't it? It's the recapture of depreciation as well. That two banger can really get you. And you're absolutely right. If you don't make the 1031 happen, then you're going to pay that. And it can be very painful. I usually tell people two things. First of all, don't be scared of that. Don't be so scared of that that it makes you run into a bad decision, because nobody ever went broke paying tax on profit. It just feels like it at the time. But it's always better to not get a deal that you shouldn't. It's not the deal that you don't get that kills you. It's the one that you do get that you shouldn't have. So I tell people, don't change your underwriting parameters. Don't change don't let your fear monitor get blunted. Be wise and don't get into a deal just to save the tax, because there are plenty of ways to mitigate that. And I know you're actively involved in a bunch of them. So if you guys are looking for replacement properties, and we had this chat right at the beginning, if you're not finding the bricks and mortar you like, you're looking at DSTs. You're looking at zero coupon DSTs that will absorb debt if debt's an issue. You've got tenant in common projects. These are all passive ways to place your 1031 money if you're having trouble finding the right replacement. But it keeps all the tax deferred. It keeps all the components of the internal rate of return still going forward. Another one that's becoming really popular are, well, has been for a while, syndications, where general partner or limited partnership syndications, where they are cost segregating and we're taking bonus depreciation early. They call that the lazy 1031. So you've got a 1031 exchange and it's not going to work. Couldn't find anything you want. So you've got this potential massive tax bill. You take that money and you put it into a syndication that's offering you bonus depreciation and cost segregation. So that will offset that depreciation, recapture, and gain that you would have had in that year. Now, the only thing I don't like about that is that that's where it stops. Because when that syndication sells, now you're going to have to pay the piper or
Yeah,
go
you would
into
have
another one.
to exactly. You'd have to basically tick from deal to deal to deal with the sponsor, and there are some downsides associated with that as well too. The beautiful thing is if you have your own tenancy in common, your own tick structure, which we typically implement the tick structure. We don't do any DST, so I can't speak to that. But when you do, which is a Delaware DST, it's Delaware State Trust, if I'm not
Delaware
mistaken.
Statutory Trust, right?
That's what it is exactly. So when we do the tenancy and common structure, the tick structure, one who's got a deal that's selling here, they're a tired landlord, they don't want to deal with it anymore. They want to sit back, relax, be on the boat, sip a mai tai on the beach, do their thing. They come into our deal. The beautiful thing about that actually is they can be in our deal and they get autonomy to tick into a different deal, their own deal, depending on where life takes them with how everything is structured. As opposed to if you're, just typical investor like myself, who's putting money into our deals, I do get the depreciation, but I don't get the autonomy now. Let's say if I've got $200,000 to play with, I don't have the autonomy now to go buy a house. I don't have the autonomy to go buy, a gas station, whatever it is. I would have to basically stay with Lone Star Capital as a sponsor from deal A to deal B, or take the gain and pay taxes back there. So there's different strokes for different folks, but those are just the
Exactly.
nuances associated there.
Do you, which do you prefer in general, both for yourself and for Lone Star, the tick structure or limited partnerships? Which are easier for you guys to administrate?
Yeah, so we typically do it in the tick. So we are always doing it in the tick structure with Lone Star Capital.
Got it. There is a pretty cool way now that people are starting to unlock that will let you get into syndication investing and lets you still keep your tax deferral on the outside as a limited partner. And what it involves is, you mentioned it way back at the beginning, refinancing and taking cash out. Because people will sell a property, they go, I don't want a 1031, I want to go passive. I want to go into a syndication. And that's really where they ought to be talking to you about doing the 1031 into a 10. But if they can't do that, the minimums aren't right or whatever, but they still want to invest in a syndication, then there's a couple different things they can do. First, they could complete a full 1031 exchange and then do a cash out refinance. Take the cash out refinance money and invest that in the syndication because that's tax free money. So you're not losing your tax deferral, but you're keeping your tax deferral on the outside with the 1031 exchange. It's actually not uncommon at all for people to do the 1031 and buy two properties. One of them they will buy with cash, the other one they will buy with maximum leverage. And this is where the Delaware Statutory Trust can come into play because they're really good at absorbing your debt. So you could go buy one property with all cash and then take a little bit of cash and all the rest of the debt that you've got to deal with and go buy a DST and then take that free and clear property, cash out, refinance it, and use that to invest in a syndication. So there's all sorts of ways, like you said, to kind of jump in and out and figure out what works best for you.
And now we're going to get to advanced mode here. And I'm going to ask you a question about the reverse 1031 exchange, which is interesting as well. Can you maybe break down the reverse 1031 exchange and when that, would be utilized from time to time? Or
Sure.
do you ever work with that structure?
Oh yeah, we hate them, but because the IRS makes them troublesome. But yeah, we do them. So the statutory order of a 1031 exchange is always going to be that you cannot take title to your new property until your old property has closed, sold. So a reverse exchange doesn't change that order. It just sounds like it does. But what happens is we're able to form an entity, it's a single member LLC, that takes title to the new property before you do. And then we can hold that property for up to 180 days while you complete the sale of your old property. And then your old property sells and you do a regular 1031 exchange to buy what? This property over here that we've been holding for you. And it's really, and its concept, it's as simple as that. In its execution, it's miles and miles more complicated and expensive than a regular 1031. But where I see its greatest value is not so much in alleviating the timing. Timing is just not that big of an issue. There's always ways, particularly the bigger the asset and in commercial and industrial, there are always ways to extend timelines to give yourself enough time, whether it's additional earnest money, additional due diligence clauses, contingencies, all sorts of things can let you stretch out your purchase to give you time to close your sale. Then it's just a regular 1031 exchange. But where I see it really come into play is if someone is selling, say, a $500,000 asset, but what they want to buy is a property for 300,000 that needs a couple $100,000 of fix up. And when those improvements are done, it's going to be worth $800,000 on the street. So how can I get that using the 1031? If I simply sell for 500 and buy for 300, I'm going to pay tax on the difference. But if I do a reverse improvement exchange, we as the QI take title to that property. While we hold it, it's under your control. So then you are going to improve it by $200,000. Now, who's really improving it? We are, because we're the deed holder. So what's that property worth now? $500,000. So you sell your old property for $500,000 and you buy this property and its improvements for $500,000. Complete tax deferral. But now you've got a juiced up property that's actually worth eight. So if you wanted to, the day you take title, Again, you can cash out and refinance and pull out a ton of capital to go buy your next acquisition.
Pretty
And
good.
that's kind of how the reverses work.
Yeah. So I guess just if you could boil down some of the maybe frequently asked questions you get when people come into your systems and get into your ecosystem and want to kind of learn more about, the process, what are kind of some of the misconceptions, the misnomers, and kind of the education you typically give people when you work with a new customer?
So we spend a lot of time working with them on the two most problematic requirements are the timing, the 45 and 180 days, how they can get around that, how they can work with that, with contingencies, with shopping early, those with changing markets, those kinds of things. The reinvestment requirements, so they understand exactly what they've got to buy and whether they want to put that into one property, two properties, how they want to structure their down payments, those kinds of things. The third most frequent hiccup is in the entity because, gosh, everybody and their mother has a liability mitigation attorney these days, right? And we set up daisy chains of Syria. You guys have series LLCs in Texas, and they've got parent child LLCs, and they've got disregarded entities. And it's just a mess when it comes to the 1031 because you've got to track it back to who the real taxpayer is. So we spend a lot of time working with folks on that, how they can keep as much liability protection as possible and yet still honor the requirements that the same taxpayer happen, be the same taxpayer from the sale or the purchase. So I would say those are the three requirements where we spend the most time. The most frequent question I get, and I love it because it just tees everything up, is why should I do this? I'm only deferring the tax. I'm going to have to pay it someday, aren't I? And I just love that because I got two answers. The first one is, well, if you're going to ask me that, I'm going to ask you, do you have an IRA? Do you have a 401k? Why? You're going to have to pay the tax eventually. It's because I get the compounding effect of that deferral. But even beyond that, my second answer is, what do you mean you have to pay it eventually? No, you don't. As long as it stays deferred in the 1031, and as long as anytime you sell that property, you do a 1031, you'll never pay the tax. As long as anytime you do the 1031 exchange, you can move that property into any other type, into any other location, any other sector, wherever the market tells you. As long as you keep doing a 1031 exchange, you'll be able to move your real estate to accommodate what your personal needs are for vacation, for passivity, for increased cash flow. And here's the final one, and it's beautiful. The fourth D of 1031 investing is the first three are deferred, deferred, deferred. The fourth one is die. And the reason for that is we're all heading there. But if you die while you still got cards in the game, you've still got properties that have deferred tax. That deferred tax disappears for your heirs. You don't pay it. Your heirs don't pay it. Your estate doesn't pay it. It's what's called a stepped up basis. And so you can defer this all your life and eliminate it in your death and give your heirs the greatest gift of legacy wealth that this world has ever seen. And
Incredible.
that's the magic of the 1031 exchange.
I love that. So thank you so much for sharing that story because we work with people all the time and we kind of just boast about how crucial and important this is. So you also mentioned earlier on, I believe that you did all this to sell this, to sell that, to live your journey with your family, give back there to the most important part of your life, which is family, and sold all sorts of real estate using the codes importantly, to live the lifestyle off the rentals and sell these houses for the boat. So can you tell that story, please?
About the boat, oh, yeah. And we combined the two. So we started in Denver, and every time we sold an investment property, we would 1031 exchange it. We were only doing single family rentals and duplexes in Denver. And then periodically we would sell our primary residence. So we moved from Golden to Lakewood to Littleton. And then we realized that at some point in time, we were going to have to get to water because there's just not a lot of sailboat water in Colorado.
Last
So
I
we
checked,
started,
no.
yeah, right. So we started at 1031 exchange our investment assets ahead of us to Stamford, Connecticut. And we went into single family rentals there. And strangely enough, I actually bought a property to refurbish it as a movie set. Whole different story for another time. But any type of real estate for any other type of real estate, right? And when we moved there, we sold our last primary residence. Remember my illustration from the Cincinnati guy? We did not go buy another primary residence. We moved into one of our investment properties. And then we realized real quick the first year we were there that Stamford, Connecticut, although it's beautiful, never gets sunny and the water is never warm. So we said, wait a minute, we're out of Dodge. We're going to Florida. So we did the exact same thing. We 1031 exchange our portfolio down to Florida. And this time we exchanged into some commercial properties, some fourplexes, and some vacation rentals. And again, when we sold our primary residence to move to Florida, that was our last primary residence conversion. We converted one of our vacation rentals into our primary residence. And then that's what allowed us to move from Colorado to Connecticut to Florida, combining those two statutes to buy the boat tax free and to live off of our vacation rental investments. And they were there waiting for us when we came back off the boat. So then we started at 1031, back into rentals, back into some land development projects, and those kind of things. So without missing a beat, we've continued to keep that tax deferred because anytime we sell, we do the 1031.
Amazing. Can you share before we go real quick? So we're about to take off. You've been so insightful today. Where people can find you, your book, the whole nine, and how people can get into your ecosystem to work with one of the gurus in the 1031 exchange space, one of the best QIs, qualified intermediary here, Mr. the one and only Dave Foster. How can people get a hold of you?
The book is called Lifetime Tax Free Wealth, the real estate investor's guide to the 1031 exchange. And you can find it on Amazon, the usual sources. The best way to get a hold of us is to go right to us at the1031investor.com. If you go there, you'll see we've got calculators. We long ago when I realized that education is the key to this whole thing being successful. People have to understand what they can do. So we created our identity as the QI that educates and walks with you through the testing. So there's calculators on our website to help you figure out gains and calendars. There's access to I think we're like 40-part YouTube channel where we do shorts on new topics all the time. And you can get on there. There's ways to contact us directly, set up appointments to talk to us. We do 1031 exchange, and that's how we make money. But I help people build their lives using the 1031. And I really do that for free missionally because that's what we believe in. We want to give back.
I love that. Well, Dave, thank you so much for coming on the show today. For all the listeners on Fun Friday this episode, people, this is your ticket to long-term and generational sustainable wealth. This is not something where we're reinventing the wheel. This is not rocket science. This is just legitimate, easy to digest, tangible information that is probably impacting everyone's life because we're going to live somewhere. You're going to own houses, hopefully invest with Lone Star Capital, and you defer. Guys, this is such a crucial episode. Dave, thank you so much for coming on the show.
Awesome to be here. Thanks for having me.
Everyone who's listening this week, we appreciate it. We'll see you next week. Peace.